Hello guys, welcome back to Channel for Trading. Today in this fifth episode, we are going to see two more income strategies which are covered short straddle and covered short strangle. In episode 4, we have seen till long iron contour. If you have not watched that video, I highly recommend you watch till the episode 4 before continuing with this episode, because I have split the episode in such a way that you can watch the video and you can take a trade during that week and understand that strategy in live trading and then build on top of it to understand the next strategies. So today the covered short straddle and covered short strangle both are going to be advanced strategies, but it is of high risk. So I won't recommend you taking a trade using these two strategies which we are going to discuss in this episode, but consider this to understand the concept only. I don't recommend you to apply this strategy in options trading. This is just to understand the concept. This is a modified covered call strategy which we have already discussed in the previous episodes. So watch that episode to understand that what is the base of this strategy and how it is modified and why it has become risky, that we are going to discuss in this episode. So let's see, as I said, advanced and most risky type of strategy which can be deployed only on a highly bullish stock or index. This strategy has three legs: long stock, that is already stock which we are owning, then short put and short call. This concept is to increase the yield of covered call by selling a put at the same strike as the sold call. With a covered short straddle, we are almost certain to be exercised because we have shorted both the put and the call at the same strike price. So unless the stock is at strike price at expiration, we face a certain exercise which many people are uncomfortable with. If the stock is above the strike at expiration, then we are quite happy because our sold put expires worthless, our sold call is exercised, and we simply deliver the stock which we already own. That is a happy part, and we get maximum reward also in that case. Now let's see the overview of covered short straddle strategy. As I mentioned, buy stock and sell OTM call and sell ITM in the money PE, which makes covered short straddle. The net credit, option premium received plus the strike price minus stock price paid. The risk, stock price paid plus the strike price which we have chosen, then minus the premium received. So reward is actually the net credit, and break even, strike price minus half the premiums received minus half the difference between stock and strike price. When to deploy? With covered short straddles, your view should be highly bullish, that is expecting a steady rising price. It should be highly bullish. Effect of time decay in your favor, it will erode the value of options sold. And you can see the option Greeks for this strategy: delta, vega, gamma and theta, and the explanation is also here. Now let's look at the trading examples. Consider stock A is trading at rupees 2115 on December 28th 2020. Buy one lot of stock A for rupees 2115, sell one lot of 28th Jan 2021 2250 PE for rupees 195, sell one lot of 28th Jan 2250 CE for rupees 68. You can see we have chosen both the same strike price. So with this example, let's see how the calculation is coming. You can see the strategy here: buy stock plus sell OTM CE plus sell in the money put, covered short straddle, and net credit it is 398. Maximum risk 4102. You can see it is much higher, and maximum reward is the net credit, and break even point is your 2051. If you have any doubts in this calculation, you can ask in the comment section. I will provide you the exact calculation based on these figures. This I have just mentioned as an overall figure here and here. In the previous slide you can see what is the exact calculation. If you're not able to get into the actual figures, then I will explain it again in the comment section. Please ask me there. And what is the major disadvantage? It is a high risk, high cost strategy, so it is not recommended. Okay, this episode, just consider it to understand the concept of this one, and do not use this one for trading. And I'm again repeating the same which I told in the beginning of the episode. Now let's see the next strategy, which is covered short strangle. And this also, like the previous one, it is advanced and risky income strategy, but better compared to covered short straddle. But this also I don't recommend for taking it in live trades. You can use paper trades to understand the concept, and do not apply this strategy because it is of high risk. This strategy is also having three legs: buy stock, sell OTM PE and sell OTM CE. So both the PE and CE are out of the money. That is the difference between short straddle, covered short straddle and covered short strangle. So choose the strike price for OTM PE which should be lower than the price of the stock at option expiry, and both the PE and CE should have same expiry. Now let's see the overview. Strategy we have already explained: buy stock, then sell OTM CE and sell OTM PE. That makes the covered short strangle. Net credit, option premium received plus CE strike price minus stock price paid. And maximum risk, stock price paid plus PE strike price minus premium received. And maximum reward is always the net credit. Break even, there is no certain formula for this one, but it cannot be defined. That's the reason there is no straightforward formula for this one. It depends on relation between the stock price, premiums received, and the strikes chosen. So when to deploy this one? With covered short straddles, your view should be bullish or sideways, and definitely doesn't going to fall below the PE strike which we have chosen. And effect of time BK in your favor itself, it will erode the value of options sold. And you can see the option Greeks here, this delta, vega, gamma and theta. And let's see the trading example also quickly. Stock A is trading at rupees 2115 on December 28th. Buy one lot of stock A for the same price. Sell one lot of 28 Jan 2021 2063 PE for rupees 90. Sell one lot of 28 Jan 2021 2250 CE for rupees 68. Now let's see the calculation here. So net credit is going to be 293, maximum risk is going to be 4021, and maximum reward is always your net credit, and break even is your 2011. So there is no much major difference between the covered short straddle and covered short strangle. As you can if you are comparing it, you can see the net credit is little bit on the lower side. The same way the risk is also kind of reduced. So there is no much major advantage over covered short straddle, but this is of little more improved version of covered short straddle, I would say. But this also I don't recommend for you guys to take it on live trade because it is of high risk. If you have to make adjustment to this strategy, you have to pump in lot of money, and that much money we may not be having in the beginning of options trading if you are learning that option trading. And also it is of very high risk to pump in that much of huge amount to get a fairly minimum reward. You can see the reward here is 293, but the risk is of 4021, right? So I don't recommend this one. This is only to give an overview of the concept. Only for that purpose I'm doing this video. And I think for this episode, this is enough. And in the next episode, we are going to see the next two more income strategies, calendar call and diagonal call. So these two are kind of intermediate strategies again, so you will be able to take a trade after seeing the episode 6. So I'm not going to wait till the next weekend to upload the series. I'll be uploading it in 2 days, so you will be able to watch that video and then take a trade in the coming week itself. Because this episode 5, I don't recommend to take a trade based on the strategy which we explained. It is just an FYI, consider that way to understand the concepts. That's all for this week. Thank you for watching. Have a nice day. Bye-bye.